Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically in the previous lecture we had started with another important topic of mutual funds, right? These are the topics we have scheduled for the discussion, like starting with the introduction part, basic history, growth of mutual fund industries, types of mutual funds, regulations, okay, investors participation and the conclusion. Okay, these are the topics we have scheduled for the discussion. Out of these, so far we have finished only the introduction part. We had started the basic history for discussion. Okay, and the topics we are totally left with is the growth of mutual fund industry, types of mutual funds, regulations, investor participation, and the conclusion. Okay, so basically we will start from where we had left it. So let's start with the history part. Okay, so basically just don't go to this paragraph. Okay, basically if we talk about it, then we had started the discussion over the 5 layers. The 5 layers which were known as the 1963 to the 87, 1987 to the 1993. Okay, thereafter 1993 to 2003, 2003 to 14 and 2014 onwards. So this is the layer which we had discussed. Like the first layer, the UTI, Unit Trust of India, was established. Okay. Now the question is, which I'm going to ask you, like, what was the first scheme of the UTI? Like, what was the first scheme of the UTI which was launched by? You have 15 seconds to think and answer, and your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th. The time's up. So what was the first scheme? First scheme is United Scheme 1964. United Scheme 1964, which is famously known as US 64, right? That's what we had discussed. Okay, so keep this thing in your mind. All right, in the previous lecture, basically we had got some you can say words like the new offer, okay, and like the direct plan. Okay, that's what we had got. Now it you can say makes and draws the another question of arts which I'm going to ask you, like, in which of the waves out of these 1963, 87, 87 to 93, 1993, 2003, 2003 to 14, 14 onwards, in which of this you can say the wave the new offer was launched and the direct plan was launched? So you have only you can say 20 seconds to think and answer, then I will give you the answer. Your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th, 16th, 17th, 18th, 19th, 20th. The time's up. So basically the new offer was launched in the 2003 to 14, and the direct plan was launched in 2014 onwards. Okay, that was the scheme. So if we go by the first scheme, 2003 to 14, okay, new offer. So what is the new offer? What do you mean by this? So new offer is very much similar to the initial public offering or the IPO. Okay, like you could say, suppose whenever the funds you can say make, suppose these are the six member, okay, who had contributed the certain amount in the fund, okay, like rupees 1 lakh, rupees 2 lakh, 50,000, okay, 3 lakh, 2 lakh, 1,50,000. Okay, that's the amount they all have created. Okay, so what's the total of this? Total of this is rupees 10 lakh. Okay, this is the total amount. Okay, so suppose they have got a situation in which they are looking for the security which is worth rupees you can say 20 lakhs. Okay, rupees 20 lakhs they are worthing for. Okay, so just conclude the picture. For this, they have got a two chances. First is internal, you can say raising of the capital. Second is external raising. It means that if all of them raise their contribution, then they will be able to reach this amount unit. But what happens that all of them find themselves incapable to raise their capital in a manner that they will reach rupees 20 lakhs. Okay, so the first option has been eliminated. What is left? External raising. Okay, so external raising, it means that they are required to launch it, the condition into the share and stock market. Okay, so that you can say the other people who having the savings, who having the investments, they could attract it towards their fund and make the investment. Okay, so that thing is very much similar to the IPO or the initial public offering. Like in the IPO, we had discussed, suppose there is a company which having that much of capital, they required this much of capital. They are incapable to raise the capital internally. So what they will do, they will check the required capital, divide it into the certain denomination or the shares, then launch it to the public. The one who will purchase the share, he will become the partner or the shareholder, right? Similar things happen with the new offer condition. Like they had the mutual fund of worth rupees 10 lakhs, but they required 20 lakhs now. It means that there is an addition for rupees 10 lakhs more, right? So for this, they having two ways, internal raising and the external raising. And we had discussed that the internal option has been eliminated. It means that they are not capable to raise the capital internally. Okay, so what they will do, they will raise the capital externally. Okay, so they will make the offer into the share in the stock market that we are you can say inviting you towards our fund. You could come and invest your money here Okay, and there we are going to invest it this much of amount, and the interest we will charge, and then how's the distribution channel. Okay, so whenever the thing happens for the company, it is known as the IPO. But whenever the things happens in the case of the mutual funds, that is known as the new offer. Why? Because first time they are inviting the outsiders. Prior to this, only these 6 members having the ownership of this fund. Okay, so the first thing clear, new offer, how it's work. Okay, the another one is called as the direct plan. Direct plan. Okay, so what's the direct plan? Basically, allows the customer, or not the customer, basically you can say, allows the fund member to diversify the investment or make investment into some other places in consult with AMC without any distributor, or you can say without paying any diversify, or you can say distributing fees, not diversify but the distribution fees. Okay, so that is the direct plan. Allows the fund member to diversify the investment or make the investment into some other places in consult with the AMC without any distributor or without paying any distributing fees. So basically, if we go by the picture like this one, okay, suppose that person, this is the fund manager, or sorry, not the fund manager, but the fund member. Okay, he has invested the money into this fund. Okay, so that nowadays he want to reduce the investment, want to invest it somewhere and some places. Okay, so what he's required? He's required to consult it with all of them and then go to the distributor. The distributor will, you can say, gradually reduce the investment of him, then provide the money to him so that he could make this and that. Okay, and because the distributor is providing these services, so the distributor will charge some fees also, right? That's the thing. So to overcome this kind of situation, and basically you can say, to turn down this kind of situations, direct plan was launched. It means that if that fellow person wants to diversify the investment and wants to reduce the investment in this particular fund and wants to invest in somewhere else, so he is only required to contact with the AMC. AMC stands for, what is the form of AMC? AMC stands for the Assets Management Company. This is the full form of AMC. About it, we will learn in the upcoming you can slides. Till then, just remember that he is only required to consult with the asset management company, and then he could diversify the investment before having any relationship and the communication with the distributor. And because he is not taking the services of the distributor, so that's why he is not entitled to pay any distributing fees. Okay, so what that action plan, or you can say, sorry, direct plans helps the mutual fund members, because generally the people who has invested their money into the mutual funds, they got a doubt. What? That in future, if we want to withdraw our money, if we want to diversify this and that, so we have to consult with the group, we have to involve the distributor, we have to pay the distributing fees and all. Okay, so that's why mostly times the people, you can say, do not find themselves in the well enough manner when it's come to the investment into the mutual funds. But due to the two main reasons of the new offer in 2003 to 14 and a direct plan from 2014 onwards, this enables the customers to believe on it. Okay. And similar like direct plan, there is another plan which is known as the regular plan. Okay. In regular plan, fund member required to get indulge with the distributor then paying distributing fees. Okay. In the regular plan, the fund members required to get indulged with the distributor, and that's why he's required to pay the distributing fees as well. Okay. So that's how the new offer and the direct plan works. I have provided you the overview. Now come to the basic history by definition. In 1987, the government allowed public sector banks and the financial institutions to set up the mutual funds. This led to the establishment of many mutual fund companies, including the SBI mutual funds, Canara Robeco mutual fund, and the LIC mutual funds. Okay, so you could say that prior to the 1987, the Unit Trust of India or the UTI was the only option for the people, okay, to invest into the mutual funds. And we know that whenever there is a lack of options, so this will always lead to the monopoly conditions. And the second is the what? Monopoly conditions. And second is less facilities to the customers. Okay. So that's why when the government come to the 1987, they found that the mutual fund having the potential. So to increase the competition and to increase the options, the government allows the public sector banks and the financial institutions that they could come and participate and could set up the mutual funds. Okay. And this basically leads to the establishment on the earlier basis for the SBI mutual fund, for the Canara Robeco mutual funds, and the LIC mutual funds. Okay. The liberalization of the Indian economy in the 1991 further fueled the growth of mutual fund industry. Private sector players entered the market, bringing in new products and the innovative investment strategies. Okay, so you could say, like prior to the 1991, okay, prior 1991, what was happening actually? That the Unit Trust of India. Okay, so prior to the 1991, the Unit Trust of India was having the entire rights to manage the mutual fund industry, right? Okay, then we know that in the 1987, what happened? That the public banks and you could say financial institutions the public banks and the financial institutions were also allowed to participate into the mutual fund industries. Okay, but just look at the picture. What you are seeing, we can see that the no private player was allowed. Okay, only the government authorities the government bodies were allowing to participate into the mutual fund industries. Why? Because we know that before the 1991, when the new economic policy was not introduced, NEP was not introduced, the entire system was under the control of the government. Okay, and the governments were trying to allow the private players into the less participation. Okay, but when 1991 came, the government realized that the participation of the private players is essential, not only because the option will increase, but new innovative ideas will be introduced, which are beneficial for the economy's benefit. Okay, because in the previous you can say lectures we had seen that the government authorities, or you can say the government banks and the financial institutions, were not performing well as they were expected to perform. Okay, and because of this, what generally happened, that the major banks got shut down, the economy was suffering. The same thing was happening with the mutual fund industries. Like, it was expected that the mutual fund industry will grow, okay, at the tremendous rate, because the people are getting the options to buy and you can say to buy and hold the securities and the shares, all right, with less amount. But unfortunately, what was happening, the conditions were not as they were supposed to be. Okay, because the public sector banks, the financial institutions, the unit trust of India, they were not performing as they were expected to be. And that's why in the 1991, the government finally realized that private players entry is crucial if we want to modify the system. Thereafter, the Securities and Exchange Board of India was established in 1992 to regulate the securities market, including the mutual funds. Now, there is a one mistake. And what is that mistake? I want you to identify. I am giving you 20 seconds to think and answer. Then I will tell you what is a mistake here. So your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th, 16th, 17th, 18th, 19th, 20th. The time's up. So basically, if we talk about the Securities and the Exchange Board of India, SEBI, okay, so it was not established in 1992. It was established in 1988. Okay, as in non-statutory body. Okay, and in the 1992 was granted statutory status in 1992. So that was a mistake here. Some of you may identify it, some of you may not. Okay, but those who have identified, well done. You are revising the things on a timely basis. And some of those who haven't identified, it means that you are not revising things on a timely basis. Okay. SEBI introduced regulations to protect the interest of investors and ensure the transparency and the efficiency of the mutual fund industry. Why? Because, however, the money which has been created by the mutual fund is basically from the money pooling technique, right? The money does not belong to the single owner. But unfortunately, we know that the money is basically, not unfortunately, we can say that in the ending, we know the money is basically utilized for buying and selling of shares and securities, right? So that's why the buying and selling of securities are generally happened at where? Share market. And share in the securities exchange market comes under which organization? Comes under the SEBI. Okay. So ultimately, the SEBI also having the control over the mutual funds. Okay. And basically, it is ready to regulate the area so that it could protect the interests of the investors and it could ensure the transparency and the efficiency of the mutual fund industries who are investing their money. Okay. So students, basically in this lecture, we have finished till this point. From the next lecture, we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say, thank you.